Hi, I'm Kunal, and this particular video will be understanding how exactly the pricing of any option works, whether it is a call option or a put option. Again, I'll be taking the very same example of Reliance as a stock and we'll be understanding it from the call perspective. And once we do that, you can very well replicate the very same idea for a put option as well. So, the whole idea here is that I'm standing on 31st May. Alright, the current stock price of Reliance is 2400. Alright, Reliance is trading at 2400 rupees, again an hypothetical price, not related to what it is currently trading in the market. And the exercise price is 2300. Those who have watched my previous video would understand how exactly exercise price works. So basically, if I want to enter into a call option as the long party, I am getting the right to buy the stock of Reliance for 2300 from the market. Alright, so that is the exercise price, or that is the agreed upon price. So in this entire agreement, we are entering into a contract where I, as a long call party, gets the right to buy the stock of Reliance at 2300. Alright, so that is the exercise price or the agreed upon price. Very simple to calculate. Alright, and when I am going in the market to buy this particular right, I have to obviously pay a certain premium because there's no free lunch. Alright, so you need to pay a certain premium. That premium amount is, say for example, 120 rupees right now. Alright, the premium amount is, say for example, 120 rupees, and you need to pay that much of money in the market to the person who is willing to take a short position in this particular transaction. So the call option premium value or the call option price is 120 rupees. For this exercise price, for a time duration of 1 month, that is, the expiry is on 29th June, which is a Thursday. Alright. So one more thing that you need to note here is that generally whenever you see the call option price or the put option price, you would see the price written as CE or PE. Alright, CE means call option European, PE means put option again European. So when we talk about European options, what we mean here is that the buyer gets a right to exercise his his right only at expiry. And again, if it is not European, if it is, say for example, American, in that case he can exercise his right during the entire tenure of that option. But in India we follow European, and in most markets generally European options are being followed. So that is why you see the name written as CE and PE in the markets. Alright, so coming back to the example, 120 is the call option premium that we have seen. Alright, for the right to buy the stock of Reliance at 2300 1 month down the line, that is on 29th June, as a long call party person. Alright, now this 120 rupees comes from two places. Alright, it comes from the intrinsic value of the option and the extrinsic or the time value of the option. Alright, so 120 rupees I have divided into two parts, as you can see, intrinsic and extrinsic value. The calculation of intrinsic value is pretty simple. Alright, the whole idea behind intrinsic value is, if you exercise the right to buy the stock of Reliance at 2300, how much money will you make? So you go in the market, or you basically ask your short call person, I want to buy the stock of Reliance at 2300, and you go and sell it in the market for 2400. Why are you able to sell it in the market for 2400? Because the current price is 2400 and you have the right to buy it at 2300. So you go and get it for 2300 and buy and sell it in the market for 2400. So whatever money that you will be able to make right now, alright, in the entire transaction, if you get the right to exercise it right away, so that profit or that amount of money is nothing but your intrinsic value. So here 100 rupees is your intrinsic value, very clear that we can make out. Now since the call option price was 120 rupees, alright, the call option price was 120 rupees, the extrinsic value or the time value which we need to back calculate, alright, so 120 was the price that the market was quoting, 100 rupees something that we can easily calculate whenever we want. Alright, so the difference amount, that call option value is 120, the intrinsic value is 100. So the difference amount, that is of 20 rupees, is nothing but your time value. What is this time value? Time value is very simple. It basically gives you the value for the probability that your option can further go in the money, or you can make more profits in the entire option. Say for example, the stock price from 2400 went to as high as 2500, 2600. So there's a good probability that you would make more money. The value attached to this probability is nothing but your time value. Alright, and goes without saying, as we approach closer to my expiry, the time value would keep on decreasing. So basically this 20 rupees value would keep on going down as you move towards expiry. The reason why is it so? Because the chances or the probability for you to make more money would keep on reducing, because आप कम time दे रहे हो आपके stock price को और बढ़ने का. Alright, so that is pretty simple, very easy to understand. Now say for example we waited the entire period, we came on expiry date. All right, now the stock price must have made certain movements. So let's see how the profits would work out for either the call party or the short party in two different scenarios. So case 1 is the case where the stock price from 2400 has gone to as high as 2700. In this case the winner is a long party. Reason being because he had the right to buy the stock for how much? For 2300. So he buys it for 2300, sells it in the market for 2700, makes a profit of 400. Is 400 the entire profit? Not really. 400 is not the entire profit, because out of this 400 he has also paid a premium of 120 rupees because he wanted to own this right, and since he wanted to own this right, he has to pay a certain premium, and that premium we need to subtract in order to get the correct price, or the correct profit rather I would say, of the long party, given that the stock price has gone to as high as 2700 in the first case. When has the stock price gone to 2700? On the last Thursday of June. All right. In the second case, say for example the stock price has gone to 2200. All right, it has gone to 2200. Now what will the long party do here? The long party will not exercise his right, because why would he buy the stock from the short party at 2300 when he can actually go in the market and buy it for 2200 itself? So the long party will not exercise his right. Now who makes money here? The short party makes money here. How much amount of money will the short party make here? 120 rupees. Why 120 rupees? Because that was the premium that the short party had collected from the long party at the initiation of the contract. So 120 rupees goes in the pocket of the short party. That is why we call it, that is why we have written that the winner is the short party here. Alright, so the arrangement is pretty simple. Alright, if you're buying a call option, your expectation is yes, it should go, the stock price should go upwards, and it should go beyond the exercise price, should remain very high from the exercise price on the upward side. And if your thought process is to, if your thought process is that the stock price might not increase and it will come down or it will remain stable, you might as well take a short call position where you will collect the premium from the long party, and you will say you will be able to make a certain amount of profits. Now in the entire arrangement, one thing that also we need to notice here is this call option that I bought on 31st May for 120 rupees is tradable. Alright, I need not wait till 29th June to exercise my right and make money. Say for example on the 5th of June or the 4th of June, the stock price has moved significantly, say for example on the upside. Now if the stock price has moved on the upside, you will also see that this particular call option value has also increased. Now in any kind of transaction, if you want to close a particular transaction, what you need to do is you need to take a reverse position. So here you had taken a long call position. Now 4 days later you can as well take a short call position, and your transaction would be nullified given whatever XYZ amount of profits you have made. Now most of the option traders, they do not really wait till expiry. Alright, in terms of if they have gone long call, or in case short call, people do it differently, but in most cases they keep on transacting. Alright, they keep on buying and selling. The idea is not to make money on expiry. The idea is to make money while trading options. So this is the entire idea. Like how we understood the call option, you can very well understand the put option as well. Works in the exact same way. Alright, there is an intrinsic value there is an extrinsic value there, which is nothing but the time value. There is an expiry date there is a certain case where the long put option would make money, there will be a certain case where the short put option will make money. So that is pretty simple to understand. Given that you understand the call option pricing very well, in the very similar way you will be able to understand the put option pricing as well. I hope you understood how the pricing works. So next time you log in onto your Dhan account and see the option chain, for any exercise price for a given date, you will be able to now relate the bifurcation of that price into the intrinsic value and the extrinsic value of the XYZ option, whether it is a call option or the put option. Make sure that you practice it for the put option and put across your thoughts in the comment section. This is not an individual video. We'll be talking more about options trading and how the basics of options work around. So make sure you keep yourself engaged with this entire playlist on Upsurge, where we are talking about options trading and how it exactly works around. Thank you.